Larry, welcome to the show. Glad you be here.
Hi, Dan. Thanks very much.
All right. There's a lot to talk about here. You had a book come out this year, and you have quite a bit of experience on Wall Street. And I'd like to begin, if it's okay, because you're, I think, the second or third guest we've had who worked inside Lehman Brothers. Um,
Yeah.
And I'm just dying to. I just want to collect all the real world anecdote that I can on these things on the show, and I'm wondering if you think there's anything during your time there that's worth talking about. You were there during the crisis, were you not?
Yes, I was a trader at Lehman. I ran a high yield distressed trading bond business, and I left just before the crisis. I mean, well,
Mm.
just before the fall. There's a group of
Right.
us that left the bank. But the first book was. It's now been translated to 12 languages. It's voted by the CFA Institute as the top 20 books all time in finance. And it was called A Colossal Failure of Common Sense, The Inside Story of Lehman.
All right. So you have a few things to say about that. Is there one particular? Was there a moment when you said, "Oh my God, it's much worse than I ever thought"?
Well, it's similar today with, like, you think about oil touched the all time high on July 11th, 2008. July 11th, 2008. Now, think about that. Um,
Yeah.
they told us a year later that we went into recession in November 2007. So this is what can happen with groupthink around, like, inside of Lehman on Wall Street. The groupthink was so delusional that oil could go, up 40% in a recession, right ahead of the biggest economic, crash since the Great Depression. So many people forget July 11th, 2008, oil hit like 147. And it was really just mass delusion inside the bank and around Wall Street.
Wow. Um, I mean, from the outside in, I might have said that very same thing, but to hear it from the inside out is it's actually surprisingly
But it's
disconcerting.
similar to today, where, like,
What's the, it isn't,
I mean, what's interesting is the
good.
semiconductors just touched on July 11th. On July 11th, 2024, the semiconductors touched an all-time high, and the delusion there is probably on par with the delusion of Lehman in terms of, like, the distortion of, the upside potential versus the downside risk.
Wow. History sure does rhyme sometimes, doesn't it?
Yeah.
Uh, so you sound like you're kind of a bearish guy right now.
Well,
Uh,
bearish on, like, so here's what happened. The Lehman response. I'm not
mhm,
bearish on some things, bullish on others, but the
mhm.
response to Lehman was a fiscal and monetary response of about $3.5 to $4 trillion. That was the response to Lehman Brothers, which was the greatest bank failure in the history of the world.
This is,
And so that was the fiscal and monetary response to Lehman. The fiscal and monetary response to COVID, plus the banking crisis of the last 12 months. We had Silicon Valley Bank go down, we had New York Community Bank and Signature Bank. But that fiscal and monetary response has been $16 trillion. So 4 trillion versus 16. and, and the point is that when you have that type of economic distortion, that kind of fiscal and monetary stimulus oozing its way through the system, it can really distort asset prices. So financial assets, like the NASDAQ 100, is now $24 trillion inside of it. Like a year and a half ago, there was 12 trillion. So it's 100 stocks with $24 trillion. A year and a half ago, it was 12 trillion bucks. Commodities are like natural gas, oil, copper today. They are extremely cheap. In other words, if you add up all the copper companies, all the uranium companies, all the oil and gas companies, you're really only you're probably 18 trillion, maybe $19 trillion less than the NASDAQ 100. So the NASDAQ 100 is essentially like 18.5 trillion dollars greater in value than all the copper companies, all the oil and gas companies, all the uranium companies, and all the metals combined. So that's where the distortions are right now. So we see a big flip where capital migrates back toward real assets, right? Back toward hard assets in the coming 12 to 24 months.
Well, you're speaking my language. I've been singing that song for for several months, better part of a year actually. So that would be welcome to my portfolio and to my readers' portfolios. Um, Let me ask you a question. I hadn't planned on asking this, but it's something that's been on my mind, and you just reminded me of it. Um, you reminded me of it by making a basic bullish case for commodities, which sometimes accompanies an uptick in inflation, could accompany an uptick in rates. What do you think are the prospects that say Donald Trump gets elected? Um, What do you think the prospects are? You think that means anything to like the bond market? You think we get another like sort of mini or full-blown bond market riot like we did in 2016 to 2017? I think the 10-year went from like 1.8 to 2.5 in 3 months or so. Um, and maybe what does that say for equities is the ultimate question to our listeners.
Well, the moment of the literally since that first debate where Trump, you know, won the debate, but it was more by default by Biden, but
Exactly. Yeah.
um, the curve, what we call bear steepen. All bear steepening means is that the 2 year, say here's the 2 year Treasury, here's the 30-year Treasury. Normally the curve will steepen coming into recession by the 2 year going down, and the 30
Mm-hmm.
years maybe going down, but the 2 year going down more. A bear steepener is when the 30-year goes up and into potential economic weakness, and that's what's been happening. So we steepened about 30 basis points on 2s, 30s, and some of it was what's called bear steepening, and that's where. And so what's if you talk to global investors, because we had an assassination attempt, and because we had this potential Trump president, all this dislocation, there's less confidence. So 30-year bonds are, with all the debt that has to be issued right now, everybody knows we're running like a 6-7% fiscal deficit. That's like World War I, World War II levels. So because we have to issue so much paper, and because it's Trump, which is considered kind of an MMT, modern monetary theory, kind of cowboy presidency, and because his vice president is still kind of wants a potential dollar reset, which he's been documented in all kinds of videos and writings and interviews, a depreciation of the dollar kind of regime. All of this has long-term bond investors very, very uneasy.
Mm-hmm.
And yeah, that's, I think, exactly what's going to happen is the long end of the curve is what we call the term premium. There's all that means is it's a complicated term, Wall Street term for meaning that there's less confidence in the longer term treasuries now than there has been historically, and people would rather own the shorter term because they're worried about the Trump and the potential implications of the Trump presidency.
Are people worried
Right.
about inflation too, just being higher than it's been in the last, I don't know, however far you want to go back, like moving ahead? It just feels like these institutions aren't taking inflation from like the outside. Like they're not taking inflation seriously when you have a Fed saying we're going to cut rates when the rate's still above that supposed 2% target, and um, it just doesn't seem like doesn't seem to make sense if inflation is still high, but we need to juice the economy.
Right. Yeah, and if you look back, Corey, over the last 2,000 years or something like what we've studied this in our book, but you go back 1,000, 1,500 years, but any civilization with even a 3% inflation rate can be very, very, very problematic. And that's why the government officials and the Fed, they will always say in every press conference that long-term inflation expectations remain well anchored. They say it over and over and over and over again, but because they're dealing with the serpent, the beast, and they're dealing with some dangerous things, right? They don't want civilization and the voters or to get uneasy. They want, it's like the pilot on the plane, right? If you have an engine on fire, he's going to say, ladies and gentlemen, just stay in your seats. Everything's going to be fine, right? So it's the same thing with inflation. Inflation's come down good, because they've hiked some rates, but they're also now, like you said, Corey, softening the path forward, and it's very, very easy. Every time they've just softened the message a little bit, inflation expectations bounce again. What we call financial conditions start going crazy, and that's people investing in the market, speculating, and that's very inflationary. Wealth effect is inflationary. So yeah, there's no question that inflation normalizes in the next regime at 2.5% to 4%, versus the previous regime was 1% to 2% inflation.
I'm glad you mentioned financial conditions. What do you make of like higher than 40 plus years interest rates and housing unaffordability at extreme levels, and really loose financial conditions as indicated by the like the Goldman Sachs Financial Conditions Index? Those don't seem to go together to me.
No, and it's one of these situations where people are in their homes, they're not selling. So there's that, like you said, there's not a lot of supply. But
Right.
anything that triggers, like that's the dangerous thing about rate cuts now is if you do cut rates 100 basis points, that typically the last like 20, 30 years would help the economy. But now if you cut rates 100 basis points, there's a lot of people that are stuck in homes that are just going to be, because rates are lower, people can buy your home now, and therefore there could be this like massive supply. What we talk about in the book is the boomers, right? The boomers have 79 trillion of wealth, 79 trillion. And the oldest boomers are about 80 years old. So it's an easy thing to remember. Close to 80 trillion of wealth, and the oldest boomer is 80 years old. So you think of like the next 10 years, those boomers are going to be a lot of the boomers, because they're getting older, selling their homes. That money's that's a lot of supply that's going to come on the market. So there's a lot of complacency around the housing market right now because prices are up because there's no supply. But the boomers, like I said, control 80 trillion of wealth. The oldest boomers are 80. So they're going to be selling assets over the next 10 years at a much faster clip than they were before.
Yeah, I've heard that. I've heard that argument a lot. I always my initial reaction to any kind of like massive demographic trend like that is, it tends to stay far in the future, and then all of a sudden one day it's there. I grew up hearing people say, one day everybody in China is going to buy a refrigerator, that kind of stuff. And then and then whoa, then all of a sudden, the commodities markets go wild, like 30, 40 years later. But do you think it's if they're 80, I would assume they would be selling within the next decade or so? No?
Yeah, it's not a near-term thing, but it's just something that, so the bigger threat to housing is probably rate cuts, because the rate cuts bring rates down. And then if you're a younger couple and you're looking for financing, you're at a lower interest rate, and that lower interest rate will potentially bring out some supply of those people that are stuck in their homes.
Right. Sure. Yeah. I frankly kind of whiff on housing. I got bullish on it last year, and now I'm out because there would be more supply. There'd be more demand too, right? I mean, and I don't have a good feel for which one would, if they would match or if the supply would overwhelm the demand, et cetera, et cetera. It seems like it seems more difficult to me rather than saying, well, be careful because there's new supply. No?
Yeah, well, one of the things we talk about in our book, our new book, When Markets Speak, is all the companies that feed into the secondary housing market, like Whirlpool, for example, Home Depot.
Mm-hmm.
There's just been a lot of stocks, Masco. There's been a lot of stocks that ADT, Security Systems. There's been a lot of companies that feed into that secondary, that existing home sales, which are really at extremely low levels. And so there's a lot of companies that have been suffering because of that, the existing home sales versus the home sales. So
Right.
there's just all these distortions in the market that are absolutely insane. I mean, just you've got like today, you got a big miss, Polaris miss. They make kind of recreational sporting equipment like jet skis and skis and snowmobiles and things like that. So the stress on like Joe Lunchpail out there, the financial conditions at that level is really high, and you're seeing that in Darden restaurants. You're seeing that in a lot of the travel names, like Southwest Airlines is your real airline to the middle class. So your middle class consumer is in extreme recessionary pain, but the top 10 to 20% are richer and have higher income and higher wealth than ever.
All right, now Larry, you're a trader, right? And yet, most of the traders I talk to, they don't talk a lot about, big economic fundamentals. They want to talk to me about, cutting losses and letting winners run in their system and how they are agnostic to the market and everything. You don't sound so agnostic. And when I look at the, just the bullet points and sort of leaf through your book, there's a lot of stuff like that long-term demographic thing that you mentioned. I guess all I'm saying, Larry, is you talk a little different than the dozens and dozens of traders that we've spoken with on this show over the past few years.
Well, thank you for that, Dan. We have a theory of like buying capitulation sell-offs. We did this with oil in 2020, uranium in 2021. What we try to do is buy into the capitulation sell-off, sell the rally 1/3, but accumulate for a 5-year trade into the future. So in other words, you're essentially like I would call it dollar cost averaging, but you're buying a third, 1/3, 2/3 of say Exxon when it's in real capitulation selling, or Chemico 2021, real capitulation selling in some of these commodity names, and then you're lightening into strength, but you want to be there with at least 1 or 2/3 for like the next 5 years. And so we'll trade around some of the position. Right now, probably the most attractive, like today, what I see is, and it's not a hardcore capitulation, but it is a very interesting capitulation relative to how bullish the upside is, and that's the copper names. So Freeport McMoran's off 20%, I think, from the highs, recent highs, 20% off. Copper's off a lot too. But if you look around the world, if you look at the U.S. power grid, you look at artificial intelligence, this is like one of these trades where everybody kind of got sucked into the copper names in the first quarter, and they've really cheapened up for a whole bunch of different reasons, whether it be China, economic risk creeping in because the Fed's telling you they're going to cut because they're worried about the economy slowing. So that's going to slow down. That's going to reduce the price of copper. So right now you can buy the copper names 20% off the recent levels, and the upside is greater and better than ever.
Did you hear that, Ferris report readers?
I was just going to say that's good news to Dan's ears. He's been talking up copper for a while.
Yeah,
the macro case.
Well,
Same thing with natural gas, where what happens is you get a bull thesis that the media starts to run with on, say, copper. And there's so many sexy elements to it in the first, second quarter of this year. Artificial intelligence, the power grid, you can go on and on and on. But then there's like Dan's saying, there's like a trading aspect to it too, where things get too pumped up. It's the same thing with natural gas. Natural gas a couple of years ago, Putin's invading the Ukraine. Europe needs the United States supply of natural gas, so everybody overproduced. And that's the thing with natural gas is, Jimmy Rogers once said, he said, trading natural gas professionally at a high level is equivalent to 4 years at Harvard Business School. and
Yeah.
and he's joking around, but it's like it's such a long-term supply versus demand. Natural gas takes so long to get to market, and the dislocations between supply and demand because of transportation get so out of whack. And right now, the bull case, the next 5 years for natural gas is better than ever. And you've had this huge drawdown that came out of that Putin, Europe, LNG exports. Everybody thought like a year and a half ago that we're going to have this new consumer of U.S. natural gas in Europe. And that's all true, but it takes a while to set it up. Things got overbought. And now you can buy companies like Antero. Companies bought back 11% of its stock, trading at like, I guess, 10%, 8 to 10% free cash flow yield. You're buying something at 3 times EBITDA. Just really cheap. Tourmaline in Canada, these incredibly cheap natural gas plays that have been taken out to the woodshed. And so, those are the types of things we're looking at in our book. When Markets Speak, it's all about artificial intelligence, the power grid, and kind of energy demand for the next 20 years.
Yeah, we had a guest on, Rick Rule, who has spent his whole career in commodities, and he mentioned Tourmaline as well as Pado and Birchcliff and a few U.S. names as well. But that was the one. Actually, I talked about at Rick's event in July of last year. I talked about copper, but this year I talked about natural gas. So same page, and it's part of my thesis was at the time when I was first getting into it, it was below $2, and break evens all around this country are basically 3-ish, except for like Permian, which is negative because of all the other stuff they produce. So I thought, well, here we are again with like uranium. The industry is basically in liquidation at that point, right? So
Yeah.
that's those are the moments I like to find.
That's where they say it's uninvestable. And whenever you hear that word, back up the truck. When Wall Street tells you it's uninvestable, that's the time you back up the truck.
Yeah, or if Wall Street says, we're shutting down our commodity operation or our natural gas trading or whatever, go. That's your green light, right?
Yeah.
Yep.
Dan, there's a scene in my book where When Markets Speak, when we talk about, I'm in Calgary with Rafi, Tasmanian, and he's a very highly respected asset manager in the energy space in Canada. And Rafi looks out the window and he says, look at all that office space. And he said, what the local wildcatters, the billionaire, brilliant kind of players do is that whenever they see that office space in Calgary go, up in, square footage from whatever it is, $5 or $10 a square foot to $25 a square foot, the real money wildcat players, the venture capital, they sell everything because they know here comes the New York bankers, here comes all the bankers back to
the out of town money.
Like typically it's town money. It's the top of the market.
Right. It was just like all the out of town money going into homes, in like the Southeast, particularly during the housing bubble, right? It was like out of town money from everywhere. Out of town money is a good one. I like that.
And Larry, that just going back to the AI stocks. So how would you be? Are you fading those at this point? Given where they're at now, I mean, just because I saw, I think yesterday I read that the hedge funds selling the tech stocks is like last week at the same rate that it was in like January 2021, which going back, that was the top of the big tech, buzz at that time and the meme stock stuff and all that stuff. Are we at the point where you're like, hey, I am selling all of the fancy AI names?
Corey, you wouldn't believe. So behind me, we run a Bloomberg chat with There's 600 people in there. A lot of them are hedge funds, mutual funds, and pension funds. And what we do is we have most people just observe the chat. So if you're a pension fund manager in Canada, the only thing you're going to say in the chat, and it's like a conversation, the only thing you're going to say all year is Merry Christmas and Happy New Year. You know what I mean? Because you're 30 years old, you're a pension fund manager in Canada, whatever it is, or you're at one of these mutual funds. But there are veteran people, let's just say you worked at Moore Capital for 20 years and now you're running the family money from Monaco or Palm Beach. Or say you worked with David Tepper for 20 years at Appaloosa, and now you're running the family money from Hawaii, wherever it is. Those people can actually be part of the conversation. And so yesterday, we had an interesting chat where it was a private conversation with a guy in the Valley that is really good friends with all of the CFOs of the Mag 7. He's been out to dinner with them hundreds of times. He's been in the Valley for over 30 years, and he's run hedge fund money, his own. Now he's running his family money at a high level, probably running like $400 or $500 million bucks. And then we had another guy who has been trading the semiconductors for 20 years professionally. And they were having this conversation around artificial intelligence. And the one thing they said, it was like two main points. There was actually three, but the main point was like, it's like the Manhattan Project, where if you're a CFO in the Valley and you're not doubling or tripling your capex the last year and a half in artificial intelligence, you're just fired. They're so terrified to be like 2 years from now left on the outside. And so what's fascinating is they're making the capex has gone from like 30 billion a year to 160 billion a year, with no visibility, Corey or Dan. No, and I'm telling you, this comes from a guy that talks to them. There's zero visibility on return on capital, right? So this is capital expenditures just being deployed at a sick, aggressive, insane pace. He called it like a Reagan-Gorbachev arms race, right? Where your CFOs have gun to their head, they have to invest. And what's happened is it's created these distortions where Wall Street analysts, are falling all over themselves to upgrade NVIDIA. And but this CapEx trajectory is just not sustainable. And the market's starting to figure it out now, right? Because the amount of CapEx, that growth rate, is what's fueling the NVIDIAs of the world. And their point is like, take the Blackwell chip, for example. This is like the new NVIDIA. If you look at NVIDIA's chips that they have been selling over the last year versus the next generation, they're going to be like, they should fall 90% in price because of the power because of the new chip. And so you've got this new generation coming on, you've got this supply of existing chips, and you've got this CapEx, and the whole thing is starting to kind of just the very early stages of an unwinding. And the last thing I'll say, and this is the most important thing, when I pushed back, I said, what makes you think this is just starting to unwind? And he goes, Larry, I've been trading the semis for, like I said, 20 years. I always look at the reaction function. And that's really important for people listening to us, right? Like, what's the reaction function? What that means is, think of like ASML or Taiwan Semiconductor. Last week, they came up with okay numbers. It was called like a nice beat for Taiwan Semi, and it was considered very good numbers. And the stock sold off kind of violently on pretty good news. And so 4 or 5 months ago, 6 months ago, these stocks would have been up to 20% on that news, right? Then the White House comes up with this announcement of like a regulatory restraint, potentially tariffs, whatever it was, around semiconductors in China, the whole thing. We've seen this headline like 6 times over the last 6 months. But lo and behold, all of a sudden, the reaction function, these stocks sold off on that news as well. And it was like, okay, this is the first time that the hottest stocks in the hottest sector are actually selling off on news, and they're reacting to news. And that tells you that there's some type of change going on in the SMH. Yeah. So the SMH of the semiconductors, it recently was 44% above the 200-day. Intel was 22% below the 200-day moving average, like within the last 4 weeks. So Intel was 22% below, the SMH was 44% above. If you go back 15 years, the SMH has only spent essentially 2 weeks here. So yeah, so you're going to see this big drawdown in semis. And if you want to be long semis, I would move into something like Intel that's been destroyed that hasn't participated.
All right, that's great. You're confirming my suspicion here. So that was good. I mean, I if nothing else, that helped me out. Because me and Dan were having this conversation. We've talked about it in the video a lot, and I remember thinking back like a couple months ago, their last earnings report, and I said out loud, I was like, their revenue is up 280% or whatever from the year before. It's hard to imagine that continues, and so even if it slows down and it's still 100%, like you're not, and then the bad news starts piling up or people start paying attention to, hey, maybe this isn't have all the potential that we thought it was. It seems to me like trademark kind of, um, you know, topping out at this point as in terms of the AI like potential, like that whole narrative feels like it could be at its peak like 2 months ago.
Well, let me give you another example. So within the last month, NVIDIA traded 90% above its 200-day moving average. That's for NVIDIA. It was 44% for SMH, but NVIDIA got 90% above its 200-day. And that was at a more than $3 trillion valuation. The best Apple could ever do, right? In the history of Apple, September 2020, it got about maybe 50% above the 200-day, and the best Microsoft could ever do was 36%. So I think Apple was like high 50s, maybe 60%. So Apple got maybe, I think it was 60. So Apple was like 60-ish% above the 200-day moving average. And this is as of like, it takes a lot to move a $3 trillion company. So to keep a $3 trillion company like NVIDIA, that's 90% above the 200-day moving average, it takes a tremendous amount of capital to keep it there, right? And like I said, the best Apple could ever do was in the 60s, and the best Microsoft could ever do was in the high 30s to 40s. So yeah, that tells you what's about to happen. The jaws are about to come back down in terms of normalization.
Yeah, isn't this just classic mania? Isn't this just a classic mania, this AI? It's like, it's like .com. I mean, the technology could be as transformative as they say, although I'm not convinced of that entirely at all. And yet, and the very best companies in the space, we don't, argue that NVIDIA isn't a great company that created incredible, products. But we know how this goes, right? I mean,
and the worst part is like the sexiest part of the story, the energy, the infrastructure, all of this stuff's been left for dead. And so if you believe the assumptions of, say, the NVIDIA CEO or all the Wall Street analysts, then you're talking about a whole new power grid rebuild in the United States. You're talking about small modular uranium, nuclear capacity, which will increase the price of uranium probably double. So it's just like there's so many trades out there that have been kind of left for dead. It's very similar to .com, where you had the .com and it was like, okay, you wanted to belong eToys and Global Crossing and all these different Cisco systems, but all these other great trades were left behind. Nobody talked about the Googles of the world. Nobody talked about all these other technologies, the Match.com, all these other companies that would end up being long-term winners were left for dead, or nobody cared about them.
Yeah, when you mentioned your friend in the chat there talking with the other CEOs, like, we're just going to go along with this because we feel like we have to. Like that's essentially what I'm hearing. Like, yeah.
Oh yeah, that's musical chairs for sure. Yeah, it
seems insane. I mean, why is it so easy for us? I mean, I guess career risk is that real, right? That must be the answer, because it's so easy for us to look inside it, to look from the outside into it and say, well, that's insane behavior. That can't end well. And yet it's just par for the course. It happens every single time in this kind of a situation, doesn't it? I mean, why? I guess the answer must be career risk is that important. That's the only thing I can come up with, because the behavior is crazy.
Yeah, if you're a CFO in the Valley and you're not doubling, tripling your capex, you will be fired. And it's just that it gets to the point where now there's a white paper by Sequoia that came out that's starting to question this return on capital. And there was a Goldman, very controversial Goldman piece that came out a couple weeks ago. So for the first time, we're starting to see this like group of intelligentsia in the research space that's starting to question, like, have you actually done the math behind this capital spending splurge? Have you actually connected how you're going to actually make a return on capital? Because these businesses, like in the Mag 7, these companies have been very capital lack of intensive. In other words, they've been cash cows, right?
Right. That's been
Now
the
you
whole
get this group of
appeal.
companies that just been producing cash and producing dividend, not dividend, whatever it is, dividend buybacks, whatever you want to call them. And now they're going to be like, they're going to be cash intensive businesses. Like the same thing happened in the shale industry, right? They just had to, like, if you didn't invest into that bubble of shale exploration in 2000, 10, 11, 12, 13, you would be fired. And we saw what happened there. It's very similar.
Yeah. Yep. I mean, at this point, I'm in my early 60s, and I've seen, the bubbles come and go. I'm sure you've seen it too. You see the bubbles come and go, and the behavior, the situation may vary, right? The asset is different, the particulars are different, but the human behavior is absolutely identical every single time. It boggles my. It's like they don't remember all the money that was obliterated the last time. It reminds me of that bumper sticker in Silicon Valley, like in 2002 or so. Just one more bubble, please.
Well, remember, there's a line in my book, When Markets Speak, and that's the last plug I'll give. But there's a line in my book that when you don't, Dan, when you don't allow the business cycle to function over longer and longer and longer and longer and longer periods of time, you create, like, the pain of bubbles those pain cycles should be longer. But what's happened is, because we've gone into an easing process right after, obviously, .com, right after Lehman, right after COVID, we don't allow the business cycle to really clean out the creative destruction. We're not allowing that to cleanse the bad guys, right? So nobody really has any pain at all, right? So there's no recognition of pain, there's no memory of pain, and that's what creates this behavior.
And I wonder if there isn't a cumulative effect somewhere brewing that's really going to, bite us all in the rear end after 40 years of falling rates and decades of, basically, easier and easier monetary policy, among other things. I worry about that. I worry about that coupled with the rise of passive, So what happens when that algorithm of receiving $1 of capital, buying $1 of equity totally mindlessly with no reference to fundamentals, and the warm feeling we get believing that all we need to do is keep interest rates low and policy easy and we'll all be fine. What happens when that doesn't work and that algorithm reverses? That truly scares me.
Right. Yeah, the passive thing is, it's so evil, it's so despicable. I mean, to have the three companies be 23% of the S&P 500's market cap, three companies. In 2019, this number was 8 to 9% in the top three companies, right? And don't forget, in the 80s and the 90s and the 2000s, the top three companies in the S&P, the most they ever got was 8 or 9% of the market composition, right? 8 or not 23%. And that's just, like you said, it's dumb, idiotic money going into fewer and fewer stocks. And Jack Bogle, God rest his soul, is looking down, and he's probably says, this is the unintended, this was with the best of intentions. Passive was created, and now it's setting up for a really nasty turn here in the next probably 24 months.
Right, and even he admitted that if it gets to be too much of the market, it's going to be a disaster. So and that's lots of people have said that, but to hear Bogle say it, that was something.
Well, in my book, I said we sit down with David Tepper, We sit down with David Einhorn. We sit down with Charlie Munger from Berkshire before he passed away. But Einhorn said, like at some point, he didn't say passive is evil at some point. But what he said was, it's at the point where, and I said that he didn't, but it's at the point where like he's on these conference calls with his analysts and nobody's on the calls because BlackRock and Vanguard and State Street own so much of the stock, right? That you don't have these active investors that are on these calls pushing back, asking the more difficult questions. And so, it's, like you said, it just becomes a blind, the blind leading the blind over time.
Yeah, I thought Einhorn had a particularly smart way of thinking about it, where he said, "Well, we're not going to get situations where, you basically get what multiple recovery, right? You have to get the return elsewhere. You have to get it from, cash, basically, dividends, share repurchases, or, some other, maybe restructuring or something like that, something much more tangible and direct to the shareholder, rather than this, a re-rating, as we all used to call it. Used to be the standard thing that value investors like him would do is, buy the beaten down stock because you think it's going to re-rate due to X, Y, and Z fundamental reasons. But he said, nope, we had to stop doing that. And we had to go for like 15%, free cash flow yields and buybacks and so forth. So you can still do it, but man, it got harder and harder. Larry, do you care to share, a name or a particular trade or something very specific that you're doing right now with our listener?
Well, like I said before, we're about to do a trade alert, I believe, in the next day or so on Freeport McMoran in the copper space.
Right.
We like First Quantum, which is a Canadian company in the copper space as well. That's been destroyed because of this. Nobody talks about the political risk to copper, right? So think of the copper mines on the planet, right? That are supposed to rebuild the power grid. Everything's supposed to support AI. And you have like one of the most productive copper mines on Earth in Panama that was just shut down for political reasons. And this, if you look at if you look at capacity to produce in say Chile and Peru, which is 30 to 40% of global copper supply, that's also down for also political risk perspectives. So, yeah, so I think that the copper names here are extremely attractive. I do like, being short the SMH versus long Intel. That's a hard one to put on, but you just buy like a 1 year put spread on the SMH and buy a 1 year call spread on Intel. That's extremely dislocated. And then on the Trump trades, your Schlumbergers of the world are going to be in a really good spot because you've got, deregulation, exploration, drill baby drill, and if Trump wins, that's probably a double over the next couple of years is Schlumberger. So those are three ideas that we're talking about.
Sounds good to me. Thank you for that. I appreciate it, and I know our listeners do too. I mean, we're mostly in the business of teaching people how to fish, but we like to throw them a fish, and so we're happy when our guests can do that.
Well, our bear traps report is pretty good because what we do is we take it's not so much a newsletter. We recap the conversation. So we have this conversation during the day. It's like a live ideas dinner with the professionals. Then we recap it for the high net worth investor, the family office that doesn't have Bloomberg, right? Because Bloomberg is like $30,000 a year. Not everybody can be on that terminal behind me, and so we're trying to democratize information.
A worthy cause. Yeah.
Yeah, and make a buck in the meantime, right?
Well, yeah, it's a valuable. You're trying to provide a valuable service, so yeah, it's not worth zero, and you shouldn't charge zero for something that's worth more than zero. But I think you. I don't have the book, but I think you've got me convinced. So I've had it on my screen on Amazon the whole time, so I'm hitting the buy now button here, just so you know.
Thank you. And I tell my wife, as a former Lehman trader, my wife Annabella, if we sell 1 million books, we'll break even on our Lehman stock.
Oh boy!
But the first book we sold 700,000 in 12 languages, and this is the second one, so it just came out. So eventually we'll get there.
All right, I want to ask you about just one more about Lehman. You made a lot of money betting against that subprime crisis too, right? In your trading while you're there, seeing what's happening. What was that like? What was that emotion like? You're making these bets, but you're also kind of there seeing the problem and like what's causing it.
It was just like today. You had these trades on for months and months and months and months on end. A lot of these trades were going nowhere. You had to I was short MTG and Radian, which are two big mortgage companies back then, kind of like tertiary. And so I was trading high yield bonds and distressed bonds. But our bosses, Mike Gelban was an incredible boss, Larry McCarthy, they would allow us to put on hedges. And so I was short MTG and Radian, and then they announced a merger, right? And the stocks went up in my face. And I lost, millions of dollars in one day. And I had, to the point where I had traders on the desk mocking me for being in this kind of like mortgage trade. And you just had to hit singles, be careful. And I think at the end of the day, you just don't deploy the big capital until you really see the trade breaking your way. If you're too early, we were short MTG and Radian. We eventually made money on that. We were short New Century. That was a really good one. But then New Century, think about this. New Century went down in February 2007. This is one of the biggest subprime mortgage brokers.
Yep.
And then that's February 2007. So the whole thing went on another, year and a half before the real big payoffs came. So you just got to be careful with your entry points.
Yeah, that's something we've heard from a lot of people. Once either there's the one decline, and then there can be a heck of a lot more after that. So,
yeah. Understatement of the century, Larry McDonald. Be careful with your entry points.
Well, and the way to recap and the way to end is the reason that is the case is that in a bull market like this one, if you get those early tremors, right, there's such a propensity in the market to buy any dip because the people have not been burned in a long time, right? And so 2022 was the lows in October. So there's just a lot of people that really, the propensity and the incentive to buy the dip now is extremely high. So you can have any bit of bad news that kind of shocks the system, and they'll just come right back until they get that, that their fingers and hands really burnt and then chopped off. And then that's when you get the bigger drawdown.
Burnt and chopped off. This is a good place for me to pose my final question to you, which is the same for every guest, no matter what the topic, even if it's non-financial. And if you've already said it, by all means, feel free to repeat it. If you need a minute, just take your time with the answer. But it's a simple question. If you could leave our listener with a single thought today, what would you like that to be? Take your time. No rush.
Okay. You ready? J.P. Morgan, 1907. One of my favorite quotes of all time. This is after the panic of 1907. J.P. Morgan said, "There's nothing in this world which will so violently distort a man's judgment more than the sight of his neighbor getting rich."
I hadn't heard that one. That's great. Oh yeah.
That's from the heart. That's from the heart.
That's what's happening today.
Yeah.
Yeah, that's what's happening today.
Oh, that's good. I have that book. I think Bruner was his name, who wrote about the panic of 1907. I got to find that in there and mark it. That's awesome. Yeah. FOMO. JP Morgan talking about FOMO in 1907.
Yeah.
Yeah. Yeah. Yeah. It is crazy, isn't it? And you know, I was talking about that very thing actually when I was talking about natural gas and copper. You know, I found some good work by the folks at a little company in St. John's, Newfoundland called Altius Minerals. I've known them for years and I've written about them. And they did some work on the incentivization price of copper. And they say right now it's about $5 a pound. You know, that's when capital should be expected to move into it. But then they said, wait, historically it requires $10. It requires double the incentivization price for the capital to start to move, you know, because you know what happens, Larry. You know, your
Right.
neighbor doubles his money and you say, I'm going to wait. Right. It's
Right.
you know, but then he starts getting rich and you're all in. So I love that quote. I'm going to find that. I'm probably going to steal it and write about it soon. It's great. Thanks a lot. And thanks for being here. I really enjoyed this.
No, it was a great. Thank you, Dan. Thank you, Corey. It was a lot of fun.
All right.
Okay. All the best.
You too.
Okay. Bye-bye.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.